All right, check, radio check. 4:30, we're at the magic hour. It's 4:30 on a Wednesday. It's today's June 1st. Yeah. Whew. Been a blur the last couple of days. We had an event last night, May 31st, at the Mercer County Community College. I'll get into that in a little bit. So without further ado, how is provisional income taxed? Yay, taxes, but the reason this came up is because somebody had recently reached out to me and wanted to know the impact that some of their income might have on their tax return. So I said, it's probably a good topic for me to touch on. And this is not going to be all about a PowerPoint, but I'm going to try and give a high level understanding of the US tax code. So as we go through this presentation, I want us to focus on the filing jointly married. This column here, 2017, was our tax bracket. So when I refer to this column, I want everybody on the call to think of this as a graduated cylinder, right? So back from biology when we were in elementary school, right? So graduated cylinder, not every dollar is taxed at the same tax rate. So 0 to 18,650, you would be somebody married filing jointly would be at a 10% tax bracket. However, if they were single, they would get up to 93.25 until they went over to the next tax bracket. So that's all in gray, and that column is 2017. So the sort of snippet to the left is for married filing jointly, and the snippet to the right is married filing single. Now, the blue column to the left is our current tax environment. And when I'm meeting with folks for the first time, one of the dates that I emphasize is 1/1/2026. And that's a little less than 2 years away. So when you think about it, we're trying to make it through all of 24, 25, actually a little more than 2 years. And then on that date, that magic date, this column, which we are currently being taxed in, will revert to the column to the left overnight, bar any legislation or congressional tax drafting. So that being said, we know tax hikes are coming. Now, as high as some of these numbers look, and I'm not here to get into the weeds today, but we have talked about over the years that when you look at historically at taxes in our tax environment, we're in a relatively low tax environment, all things considered, based on tax history and since inception. So what does that mean? This graduated cylinder, it's the same thing. So, right now, 10% up to 19,050, and you go into the 12%, and you go, oh, 12%, that's not a big deal. But remember, on 1/1/2026, it's going to default back to the column on the left. And that will now, in essence, be, hey, listen, if you were somewhere in this column here, now you will move back over 75.9. So let's just say, for argument's sake, you're at 76,000. 76,000 married filing jointly, your marginal tax bracket is 12%. Boom, you're at 25%, just because of that little bit of a difference. And I'm going to get into that in a little bit. And this is why we at Professional Planning Services are adamant about tax planning. Right. And in looking into the future, none of us have a crystal ball, but there are steps that we can take to help mitigate this risk. And I've spent some time on this slide so that as I go to the actual calculator that I use some nomenclature, some verbiage, some financial terms that maybe are not utilized in everyday language. The first is marginal tax brackets. And that's these columns here. So wherever you are, so if somebody says you're in a 24% marginal, again, that does not mean everything up to that point is 24%. What that means is each of these areas. So the first $19,050 is taxed at 10. And then the next dollar over that gets taxed at 12. And then the next dollar over 77,400 gets taxed at 22. So that effective tax bracket, effective is another word for average. So hopefully that's clear. And I wanted to slow down and talk about that before I get to the next slide, because the provisional tax calculation is sort of something I sort of deem or term or think of as being a stealth tax, a hidden tax. A lot of times people are unaware of some of the things, and sometimes people will go to a presentation and hear something, go, oh, I hear my Social Security is going to be taxed at 85%, or I heard my Social Security is going to be taxed at 50%, and that's not how it works. So I wanted to sort of get into the weeds a little bit and pull back some layers and help you. So basically the first sentence is we're going to add up all of our taxable income. So if you're at a point where you're collecting Social Security, and now let's say that we're, you're eligible at 62, it doesn't matter. As soon as Social Security is deemed being income, it can go into our calculator. So whether you decide to elect it at 62, at 67, or 70, it's not until it falls into that category that that amount that you receive, provisional tax rates could apply. So basically, they're going to take all your wages. So if you're still working and collecting Social Security, they're going to add that in. And they're going to take your pension income. So what it is your adjusted gross income plus tax exempt income, like municipal bonds, and then 50% of your Social Security. Now, one of the things that I have emphasized before when I'm doing public presentations, when I'm teaching this, what I share is that last line: provisional income formulas does not include qualified distributions from tax advantaged accounts. The heck does that mean? Roth IRAs, cash value life insurance. So that's part of why we promote being proactive with tax planning while we can, so that we can avoid some of the pain if we're not prepared of the tax man later, and especially if they raise taxes in the future in an effort to balance the book. So hopefully that makes sense, but that's the formula if you're taking notes and you wanted to learn. Because here's the thing that I've in my career, and I've been doing this for over 30 years now, and I know that there is a segment of high income earners, or we'll say above average asset holdings, that will tend to, oh, I'm going to put my money in muni bonds because they're tax free. When I hear the term tax free, to me, they should be tax free. However, muni bonds and the income that comes from those are subject to that provisional tax income calculation. So we're going to look at that a little bit closer, but I wanted to explain that. And then this is the formula for whether you're single, filing jointly, in the threshold. So that's the amount of your Social Security that could be taxed. So the middle column is single. So, if you're earning and you have income, including Social Security, 25,000 and 34,000, up to 50% could apply, and we'll go through that calculation. And then if you're bringing in money and you're over 34,000 for a single, or above 44,000 for married filing joint, up to 85% of that Social Security could be taxed. Right about now, there's somebody in the audience that has the deer in the headlight look. Okay, I know, because it has taken me years of hearing it over and over, diving into tax returns to be able to get my head around. And it's not as complex as it sounds. And again, why I wanted to take the demonstration. So this is one of the calculators that I use. And before I bring it up live, I wanted to emphasize that when we look at a tax return, right, they've tried to simplify it. But you'll see that line one, right? Wages, salaries, and tips while we're still working. Tax exempt interest, that's what's going to go on 2A and 2B, interest income. So 2B would be interest income. And if some of that is in muni bonds, it would fall back to 2A. Qualified dividends, right? So if dividends are deemed qualified, then that means that they're deemed as long-term capital gains, which means that they're afforded more favorable tax rates depending on the overall income levels. Gross IRA distributions, were those IRA distributions taxable, right? So this is how the IRS is deeming this. Are you a recipient of a pension, you or your spouse? If so, that gets added in. Gross Social Security, and then what is the percentage of that Social Security that actually will get taxed, and what is that number? So the provisional income looks at all these areas, right? So wages, salaries, tax exempt interest, dividends, taxable, gross Social Security, capital gains, refunds, alimonies, business income. I mean, it's a pretty deep list. And a lot of times people, just dismiss it. Oh, my Social Security, it's not taxed. And it used to not be taxed. But, as this country continues to run up its debt, and the debt limit has now been increased, right, that they're going to turn around at some point in time, they're going to have to balance the books. And one of the areas, right, when you hear that people say, hey, the Social Security trust fund is going to run out of money in 2033, there will always be, for everybody probably on this call, will probably get Social Security, but there will be adjustments along the way, right? So where before it didn't used to be taxed, now maybe they tax up to 85%. At some point in time, maybe they tax 100% of Social Security. Maybe they make us wait full retirement age now, instead of being 67, maybe they push it out to 68, 69. All these techniques will be attempts to basically be able to meet their obligations. So what I'm going to do now is I'm going to bring up a live working calculator, just so everybody can get a sense of, this is a hypothetical example. It's the same thing, but now it's working. And the first thing I want you to understand that I put in there, if somebody was earning the maximum Social Security, $43,524, notice this choose filing status, this number 2. I have this person as a single that is 65 and over, and all they're collecting is Social Security. Well, if that's the case, right, they would pay 0% for Social Security, and they're entitled to a $15,700 deduction for 2023 as a single. So when I come down and I go, well, how much tax do they owe? They owe nothing. And that's why it's a negative $15,700 on taxable income. But now we're going to, in an effort to help you understand what I look at, let's just say that you were still working and you're single and you were earning $100,000 a year. And I use that number just to keep the math simple. So it's going to be 100,000 plus your Social Security of 4352. Watch this percentage line hit. Right now, it goes to 85%. And what that means is 85% of the maximum Social Security. What is that maximum Social Security number? Well, that was if somebody was a high income earner and had earned probably $120,000 for, they take the highest 35 years and calculate your number, which is called your primary insurance amount, your PIA, right? So that is $36.27 a month as a Social Security. So it's not far off or unreasonable for people to get $3,600, and that's not even putting inflation on it. That's just a number that I came up with for a high income earner. That annualized is $43,524, just so you know what I came up with. So right now in 2023, the most that you could make from Social Security full retirement age right now is $36.27, but maybe next year it might be a little higher. But right now, for examples, I want you to see it's not the full $43,5224 that is subject to tax, 85%, or the roughly 37,000. Now let's go down and see how much we owe the government. Well, if that was the case, in that example, our taxable income is $121,295. Because remember, we got a $15,700 deduction. That puts us at a marginal tax bracket of 24%, in an effective tax bracket or an average tax bracket of 19%. So in this example, for somebody that was still working, the total amount of taxes due is this number in the right-hand corner, is $116,920. I'm sorry, it's $26,525. So roughly $27,000 of their $100,000 from earned income, and 85% for a total gross income of $143,524 means they owe the government $27,000. So that puts them at roughly a gross income tax percentage, an effective tax rate of 18.5%. That's where the 19% came from. So that's all if you're still working. But what if we were one of those people that were fortunate enough to get all of our money, and you were under the impression, hey, I put all my money in muni bonds and it was tax exempt interest, and I'm getting $100,000 that way. So what does that do to our calculation? So this is for the muni bonds. I've changed the line to 2A. 85% of that is still taxed, and lo and behold, my taxable income that I thought, right, I'm still in a 12% tax bracket, marginal 11% average. My total taxes on that, instead of being 27,000, now is only 2,000. So it's not all of it is taxed. The environments that they are, but it is provisional, does mean that some portion of your Social Security, and in this case, it's only 2,300, not 27,000, right? So that's where I think there's a lot of misunderstanding on how the Social Security is taxed versus different investment environments. So now let's just say, hey, listen, I was in, I'm in a brokerage account and I'm getting $100,000 coming in off of ordinary dividends, but I'm day trading, right? So this would be deemed the same as if we were working, right? So now I'm back to 2419, and you'll see it's the same. It's 26,595. So if you got a brokerage account, you're killing you're slaying the dragon, right? Doing day trading, but because they're shorter than 1 year, they're taxed at ordinary income, and that could be problematic. Versus if you said, hey, listen, I bought all these qualified dividends, so I want to turn around and let's see what that looks like. I have an error here. So of all those ordinary dividends, 100, see if I did that right, 121, 295. But now because they're deemed qualified dividends, I don't pay the full 27. Now I'm only paying about 18. So dividend paying stocks, qualified dividend paying stocks have their advantage. So now one more time, I'm going to zero some things out, and hopefully I'm not putting people to sleep with, finger skills here. This is the one where, as I've come up through my career in helping people plan for their retirement, and one of the things I started to see is that people would retire about 65, 66, start to collect Social Security, go, I really don't need this money right now in my IRA. And this is before the government changed the rules. RMDs were at 70.5. And they would turn around and retire. And then the first year they'd say, hey, I'm going to pull some money out of my IRA. Okay, if they do that, if they take 100,000 and they do that, and they're under age 59.5, but it's a taxable IRA, which they all would be, same thing. Well, now that's income, and we're right back to where we started from. So what people figured out real quickly, I didn't like that 24%, 19%. Now I'm in retirement and I pulled 100 grand out. I really didn't need it. And I still had to pay the government the 27,000, right? So that, caused people to pause. And then what they would do is they would wait and kick the can down the road, figure out other ways to make ends meet. Maybe they would become a little more frugal, part-time work, whatever they're doing. But then remember, the government has something in place called RMDs, required minimum distributions. We cannot continue to kick the can down the road without attention to that, because now it's 73 because of the Secure Act. But if you do that, right, and you wait and you miss something, there's a 50% penalty on what you were supposed to take out. So the government wants their money. And the further and further we get down the road, and think about it, the government has taken a lot of our deductions away, right? When we were younger, we had home deductions, we could itemize, we had kids, we could take all these standardized deductions. We don't have any of that anymore. So we have to be cognizant of that the rules are changing. And if we're not aware of what's going on, we could end up getting our all this money that we have in these accounts, everything that we're earning and putting on our income tax. The government is going to basically take their bite of the apple. And then lastly, if you do have a pension, and again, it's $100,000, right? If you had $100,000 going into your pension, it's the same thing. So my whole point here that I wanted to talk about is that provisional income, and there's a calculator here, what portion of the Social Security is actually taxable. So it's 50% here. And then as we come down, right, as we turn around and pull out on a single, it's 50%. So $25,000 on top of their provisional income. And we can start to figure out their actual tax calculations. I'm not going to get into the details, but again, this 85%, depending on your income, this is just the math behind it. So this calculator for me, whether it's Medicaid, Medicare means testing, any of the things that we go through, whether we want to see what if scenarios, if somebody says, hey, listen, I'm thinking of retiring this year. Should I, get a second job? Should I take some money out of my IRA? We can start to look at this, and always double check this stuff with your accountant if you're working with a CPA or somebody like that. But I find that when I ask people for their tax returns and I plug my numbers into this calculator, because this was drafted and created by a CPA. So, all this stuff, it's updated every year. It's current. It's one of the tools I use for planning. And I find that a lot of people don't fully understand the tax system. And I try and keep it as simple as possible so that we can make good guided decisions on a go forward. So that's it on that component. And now I'm going to just bring us up to the last couple slides and we're going to wrap up. So hopefully that made sense. And then here's our disclaimers. Guys, I hope everybody stays well and reach out if you need me.